Good afternoon, everyone. You're watching Moneycontrol, and this is a fresh episode of our new series, Deal Central, where we analyze the landscape of mergers and acquisitions, private equity, and equity capital market fundraising. On the menu today are a series of key decisions that were taken recently by market regulator SEBI post its board meet. SEBI chairperson Madhabi Puri Buch wants to usher in an era of liberalization, greater flexibility, greater scrutiny, greater transparency, and she's also batting for a segment-wise approach. Now, to understand the implications of the decisions taken by market regulator SEBI on Deal Street, we are joined today by two legal eagles, Prashant Gupta, the head of capital markets at law firm Shardul Amarchand Mangaldas, and Yash Ashar, the head of capital markets at law firm Cyril Amarchand Mangaldas. Prashant and Yash, welcome to the show, and thanks for taking out time.
Thank you.
Thanks for having us.
Well, before we begin, a quick rider for the viewers. The detailed regulations are not out as yet, so today's conversation will be based on the contents of the SEBI press release and, of course, the post-media briefing by the SEBI chairperson. Having said that, let's begin the show with Prashant. Prashant, the first big decision that came out post the SEBI board meet relates to IPO disclosures. Now, what SEBI wants to do is that they want all the key performance indicators or the KPIs and the price per share of the issuers based on past transactions to now be disclosed. And this is, of course, more in the case of some of the digital companies, because the SEBI chairperson pointed out that when it comes to new age, new tech, loss-making companies, some of the traditional financial metrics are not going to be adequate or appropriate when it comes to arriving at valuation or pricing. That seems to be the thought process. And of course, she also said that there should be no information asymmetry. And at the end of the day, if the private equity investor, say, for example, is privy to some information, then so should be the retail investor who needs to be informed as well. So what has SEBI decided? The price of any new issue or private placement made in the last 18 months has to now be revealed. This timeline can go back to as much as 3 years in some cases. That's not all. The WACA, or the weighted average cost of acquisition of past deals, also has to be revealed. And mind you, this is applicable to not just the digital or the internet IPOs, but to all IPOs. So it's mandatory for all. So Prashant, we have seen in the past several of the new age companies, the IPOs have underperformed post listing. Say, for example, Policy Bazaar, Cartrade, Zomato, Paytm. What do you think could be the impact of this move on the overall filing process when it comes to issuers? And also, because this extra information is now become mandatory, do you think perhaps these new age companies will be able to sell their USPs better to the sophisticated investors that bet on these new age companies?
Yeah, no, good question, Ashwin. I'll try to take them one by one. I think as a start, a lot of these disclosures have already been in the prospectuses, at least for the last 6 to 9 months. I think the regulator has already been asking for these disclosures. I think this is just a way of codifying those disclosures. I think whether this information is relevant or not, we'll obviously have to see. Our offer documents are already quite lengthy in India compared to other jurisdictions. We're basically adding more information with respect to sort of past secondary transactions, which the regulator is now asking to be disclosed. Those can be challenging for the issuer company itself. It doesn't obviously know the price at which trades are being done in the secondary market always. So to go and try to gather that information, then disclose it in a prospectus, which is a liability document, is also sort of a leap of faith for them. We understand why SEBI may feel like it's relevant disclosure because if trades were done 6 months ago, I think that was 6 months ago at 1/3 the price. SEBI wants the retail investors to have the same knowledge now. Of course, the question is, are retail investors actually reading the prospectus, which is the million or billion dollar question for some transactions, and we'll just have to sort of wait and watch. I think KPIs are a different kettle of fish, and I'll wait to answer that separately.
Right, Yash. The SEBI chairperson recently, and this is prior to the board meet, had categorically said that it's not SEBI's business to sort of suggest IPO pricing of these new age companies. But she did mention that there needs to be a disclosure when it comes to how valuations have changed, say perhaps between a pre-IPO placement, the price then, and the ultimate price being offered later for listing. How do you respond to the need for these KPIs that SEBI has now made mandatory, not only for the digital universe, but for all issuers?
Yeah, thanks, Ashwin, for having me here today. It's always a pleasure to speak to you and Prashant. So, in addition to what Prashant said, and he made some very important points, KPIs have always been around. A lot of companies, even historically, have relied on KPIs. So, any bank or any NBFC trying to do an issue historically would have selected statistical information, and that was a KPI. Whilst one appreciates completely where SEBI is coming from and putting in more detail, I am not sure, given the size of Indian offer documents, would really help in a more informed investor. Because what does a KPI reveal? KPIs are more detailed information about certain parameters relating to the company, which do not come out from the financial data. So they are not included in the financial data and hence require better understanding. Sophisticated investors have their own internal requirements. Remember, they invest when the company is unlisted. So, these details which SEBI is asking for are when a company is unlisted, has no history of regularly disclosing quarterly results, and therefore finds it a challenge. Now that it's listed, if you're going to present, and I think for a moment we should remember all disclosures have to be made. KPIs are just additional disclosures. So if there's a trend developing that certain parts of the business are not doing well, or there's there's going to be high NPAs in people borrowing below 100 rupees or whatever it is, those have to already be disclosed. So KPIs just add to that. One could say that the KPIs disclosed so far are positive KPIs, and people don't disclose all KPIs, and SEBI could have asked for more details on certain KPIs. But by asking for these details, and this will run into number of pages, I'm not sure that the investor will get more information.
Right. So Yash is making the point that perhaps the compliance factor is clearly going to increase, and he's not exactly sure as to what the real benefits would be. In fact, both of you gentlemen have pointed out that many of these KPIs were to a certain extent already being disclosed, but clearly SEBI is not satisfied and has expressed the desire for more. Interestingly, Prashant, during the press conference, I think there was a query from the media to the SEBI chairperson that if you have such a stringent atmosphere or in terms of regulations, what if the issuers are tempted to list overseas? And that's when the SEBI chairperson said that in her personal experience during her corporate stint, overseas regulations, when it comes to disclosures, due diligence, and legal liabilities, are much more. So that's something that she highlighted during the press conference. But she also said that if there is indeed a reasonable case for excessive disclosures, then SEBI is happy to look at it. Where does one draw the line, Prashant, when it comes to the kind of information that you would want from an issuer that is seeking to go public? And where does this move places when it comes to perhaps the regime in other jurisdictions like US, Europe, say even Asia?
Yeah, I mean, again, good question. And Yash is shaking his head because I think we probably agree on this. I think honestly, having worked on transactions globally, the Indian disclosure standards are very onerous. And if it was difficult to do an IPO in India 10 years ago, now it is just a different level of complexity, honestly, in terms of disclosures and due diligence. In some cases, the asks are such that, whether there's bankers or lawyers, we are not even able to diligence that information because it's not information that is even available. But that aside, I think if you look at India vis-a-vis other jurisdictions, I think each of them has their own approach for various reasons. I think the US follows the most progressive disclosure norms, which is largely material disclosures, which you can determine what the issuer wants to do. I think if you look at Asia, whether I think China or Hong Kong probably are the other extreme, where they are very owners, maybe even slightly more than India. I think historically India has tried to balance and sort of be in the middle because we have retail investors investing, which doesn't happen in the US. But I think over the last few years, we've at least in the last 12 or 18 months, we're starting to go closer to China. I mean, I don't think I'm sure Yash and I will agree. I don't think it's a good thing from a market perspective. It does scare off, issuer companies. Obviously, I think between the government and SEBI, they have put a lot of effort and have succeeded in getting, companies, whether it's Zomato, Paytm, or Nykaa, whoever those are, to list in India and not list overseas. I think we're sort of at a critical juncture where we have created an atmosphere where these companies can list. Obviously, in every ECM transaction, some companies will do well, some companies won't do well, some will do better in 5 years. Now, the question is, when we've created this atmosphere where people want to list in India, do we want to suddenly change course and scare people away to go back? I think we're sort of at a crux where that can happen. I think we need to be very careful as to how we sort of look at the disclosure norms. But yeah, I mean, they're obviously getting more onerous than they were 12 to 18 months ago. And as Yash said, some of this information is not relevant for a prospectus. I mean, if you take KPIs, for instance, the new regulations require the issuer to disclose KPIs that may have been disclosed to institutional investors for the last 3 years prior to listing. Now, information that may have been, as Yash said, relevant for an investor in an unlisted company is not relevant for a public markets investor. That decision should be left to the issuer company whether they want to disclose it or not. I don't think we should be passing judgment on what is important for the company. I think that is for the company to decide.
Right. Point taken, Prashant. Let's move on to another interesting aspect when it came to some of the key decisions, and that's the onus that seems to have been put on independent directors. Now, over the years, we've all had several debates regarding whether there are enough number of quality independent directors, whether there is enough teeth as far as independent directors are concerned. There are opinions on both sides of that topic. But one particular aspect is that SEBI has now made it the business of a committee of independent directors to recommend that the IPO price band that has been set by the issuer is justified, and that should be justified based on the same KPIs and past deals. Yash, tell me, how do you respond to this step when it comes to increasing overall accountability? And do you think the average board in the unlisted universe is equipped enough to sort of deal with this new responsibility? And of course, it's also a fresh liability on those independent directors, Yash.
Sure. So, a couple of points. I think some of the genesis of this idea could be coming from related party transactions. In a related party transaction, there is a potential loss to a company because you're dealing with another related party. The issue and the concern I have is that in many of the transactions, including outside of the new age tech companies, insurance companies, which we've had, asset management companies, we've had a lot of transactions which are pure offers for sale, where the company is not receiving any funds whatsoever. Now, there is going to be some tension between the selling shareholder, who represent usually third-party sums of money, whether it's a fund, whether it's the government of India, and an independent set of directors, many of whom may have joined this board only maybe 4-5 months before the pricing. And many of them may have joined because they have expertise on marketing, HR, and many other functions, some even accounting. So in terms of that background, to get these independent directors to weigh in on pricing, which is a very complex exercise. Prashant and I, all of us have done many IPOs. Pricing is a very complex exercise, and it's a science and an art. But to get a set of independent directors to have a committee to approve this, I'm not sure will solve the problem. They will obviously rely on third party and other data, and they will eventually have to sign off. I hope this will not deter them from joining, because obviously by itself the IPO has liability, and now the regulators try to increase this by specifically asking for that. As things stand, in most IPOs, the board decides the price with the selling shareholder. That formulation is a fairer formulation, and that ensures that people can put their say, ask questions. And I've seen this in both government disinvestments, private sector IPOs, as well as new age tech companies, where people have asked questions and then eventually agreed on a price, because no one wants to price something which is going to be a failure. So I think somewhere some balance could have been found. We'll wait for the final regulation. But all independent directors, in my view, may not be equipped to be able to weigh in on whether the price is, can be justified or not. That could be a challenge.
Right. Yeah.
And I think just one other point to add on that.
Yeah, quickly, Prashant.
Yeah, I think that there is a fundamental, I don't know what to call it. I mean, this sort of lack of cohesion, because in the end, all directors owe a fiduciary duty to the company, which includes its shareholders, to maximize return to the company's shareholders. At that point, when a pricing decision is being made, it is their job, whether they're independent directors, nominee directors, executive directors, is to maximize return to the shareholders. To assume that independent directors should in some way decide a fairer price, I think is perhaps wrong. They should be under the same duty as an executive director is or a nominee director is.
Sure, we'll wait and watch to see how this provision is sort of streamlined as and when the regs come out. Let's see how India Inc. and the independent directors react. Prashant, one very interesting aspect, and this is something that you had told me earlier that you particularly found interesting, is the pre-filing of offer documents. Now, this is a step or a decision taken by SEBI in those cases where the issuer isn't exactly sure as to when he or she wants to launch the IPO, be it in terms of the market conditions or be it in terms of the external environment. This also, of course, also ensures that the sensitive information regarding the company is not revealed to rivals or to peers, because whatever has been filed is confidential and will not be in public domain. So, Prashant, explain the timelines involved over here, and how do you think the response is going to be? Do you think many issuers will opt for this going ahead? In the recent past, we have seen a lot of issues getting deferred, because at the end of the day, timing the market is perhaps one of the most difficult and important factors that determines the success of an IPO.
Yeah, Ashwin, I think on a funny note, I think you'll find Yash and I agree on pretty much most of these points. So if you were trying to get us to disagree, I don't think that's going to happen. But I think overall, the pre-filing, I think, is a positive move. I think, again, we'll have to sort of look at the regulation and what it says. I think there is a slight chance that it may increase the transaction time. I think, between the time you start work on an IPO and the time the listing happens, if this adds 30 to 45 days to that process, I think it becomes a little tricky for companies, particularly in a volatile market where every day is important from a marketing standpoint. If you have to do an extra audit because you have to make first a confidential filing, then a public filing, then wait 21 days and then file an RHP. You may not find many takers for this. I think there will still be some companies, perhaps larger groups or tech companies where they want to keep their information sensitive confidential as long as they can.
Right.
I don't see, it does add a lot of compliance costs in some ways every time you have to make an additional filing. So I think we'll have to wait and see how it plays out. I mean, it's a positive thing. I think, I think over time it will perhaps develop to something like what we have in the US, where, it is commonly used and allowed and, people do to make use of it. I think in the beginning, I think people may be a little bit more skeptical given the additional time it may take to complete a transaction.
Right. We have a lot of aspects to cover. Yash, very quickly on the pre-filing bit.
Yeah, just small point to add to what Prashant saying.
Please speak. Yes, go ahead.
The main reason India wants a public filing, which has been the historical reason, is that if there's somebody aggrieved with the company or its promoters or the disclosures inadequate, they raise a complaint or they go to SEBI. In the last 21 years of practice that I've seen, 99% of these cases have been blackmail. There has been a 1% genuine case where a company or the promoters have done something wrong to the counterparty, but 99% of the cases, it's pure blackmail. SEBI should also insist that if there's any complaint for a period prior to the date of public filing, within a period of a week or 10 days, whatever period is found reasonable from the regulator, you file all complaints in that period.
Yash, another mechanism, in fact, two mechanisms, REITs, real estate investment trusts, and infrastructure investment trusts. SEBI is trying to sort of push them, make sure that there is greater penetration when it comes to these two. They provided tax incentives in the past. They provided a lot of relaxation. Folks like Blackstone have come out and sort of warmed up to these mechanisms. But SEBI feels there's still, some more space to go, and that's why perhaps they've introduced a reduction in the minimum holding requirement of REIT sponsors from 25% to 15%, and that sort of brings the entire regime in line with what's the rule of the game when it comes to InvITs. What do you think is going to be the impact of this particular decision? Needle moving in a significant way?
Sure, Ashwin. So in terms of REITs and InvITs, they are largely created as a product to sort of ensure deleveraging your balance sheet, and sponsors who set up infrastructure projects or real estate projects are very keen to develop this. And not just SEBI, in fact, the government has given a lot of tax incentives. So this is again bringing REITs in line with InvITs. InvITs had this provision already of 15% being the norm for the sponsors at the stage of formation of the transaction. This is in perhaps in line with that. SEBI would like the sponsors to continue to be associated with the product and not to exit completely. And therefore, like in an IPO, they would like some amount of ownership. So it is helpful to REIT sponsors. It gives them more flexibility in structuring a transaction. But whether it's 25 or 15, or sometimes they may hold even more, depends on the pricing, the size of the transaction, the demand. Again, it's a great product. Both InvIT units and REIT units are great product for a population which is aging. And we'll see how popular it becomes, but this helps. But it doesn't move the needle from not doing or doing a transaction. It obviously helps in structuring a transaction.
Right. So a step in the right direction. Prashant, let's also quickly move on to the entire OFS mechanism. That's also a mechanism which I think SEBI wants to push. They want to make it available to a wider set of investors. And that's why one of the other key decisions is that they've allowed non-promoter shareholders with less than 10% stake to participate in the OFS or offer for sale by a company, provided they have a minimum 25 crores worth of shares to sell. The earlier regime, of course, insisted on that 10% cap. Now there's also, in fact, a conditional reduction in the cooling off period of 12 weeks, depending on the liquidity of the shares. Prashant, tell me, and of course, this is now also open to REITs and InvITs, OFS. Prashant, so tell me, will this now tempt large institutional investors who are used to sort of pair their holding in firms through block deals or bulk deals to now look at this route?
Tough to say, Ashwin. I would say probably not. I think one of the reasons large institutional investors use the bulk route is because they're selling an X number of shares. They know who they are in an OFS. There's a retail bucket, you have a mutual fund bucket. The book is open for 2 days. It functions more like sort of an IPO book. I'm not sure institutional investors who are not sponsors or promoters want to sort of subject themselves to that level of public scrutiny in terms of their sales. So I'm not sure how many will actually want to use the OFS process. I think the question really is, does the regulator want them to do the transactions on the OFS window as opposed to the bulk window when they're doing large shares? I think that it's currently not mandatory, and I would assume that institutional investors would continue to prefer to sell on the exchange rather than doing than using the OFS mechanism. I think the OFS has historically been used by the government for its disinvestments, largely because it does want retail participation. It does want more open market in terms of the price that is being determined. Because the government is selling, I think the private sector has generally preferred to use the bulk of the block route.
Right. One very quick question. We are running out of time. Yash, I'm going to post that one to you, and that's Prashant spoke about the government, and this is of course the strategic disinvestment of PSUs and the consideration payable under open offers. So what SEBI has done is that they have sort of scrapped the 60 days VWAMP, which is the value weighted average market price, and that's of course the formula that is used for determining the open offer price when it comes to change of control involving PSUs. And that's also, of course, during a government deal like this, there are frequent disclosures and announcements. They have a impact on the stock price. The period is also longer when you compare it to a private company doing it. So how important is this considering the government's ambitious disinvestment program, Yash?
No, in theory, it's obviously helpful, but as we all know, disinvestments are really complex exercises. They take a lot of time. There's a lot of political pressure. So this gives the government more flexibility to do a transaction. But you do appreciate that if the 60-day price is much higher, then the government also will have to be careful and be able to justify a lower price. So this is going to be helpful, but this is not again going to swing disinvestment by itself. There are much more complex factors, I feel, in any disinvestment, and which run much more than the price. The unions, assets, the valuation.
Point taken, Yash. Clearly a breather for the government, at least, because the whole point seems to be that sometimes, in some cases, open offers can become more expensive than what they originally thought. On that note, gentlemen, we are completely running out of time. Yash and Prashant, thank you so much for joining us on Deal Central today. and helping us analyze the impact of some of the key decisions taken by SEBI on Deal Street. With that, it's a wrap on the show. This is Ashwin Mohan signing off. Stay tuned to Moneycontrol for more news, views, and updates.
Thanks, Ashwin.